Welcome back, traders. So, let's get started. The first step in market structure mapping is to identify valid pullbacks. Without identifying a valid pullback, you won't be able to recognize upcoming price movements, such as continuation trends, valid breaks of structures, and reversal patterns. So what is the definition of the pullback? A pullback, in essence, is a temporary reversal or pause in the price action against the prevailing trend. It occurs when buyers and sellers contend for dominance in the market, leading to a trending or impulsive movement. That creates internal liquidity, characterized by inefficiency or static liquidity, awaiting to be swept or filled. Consequently, the price experiences a reversal and a brief interruption against the dominant trend, filling the internal liquidity or clearing static liquidity before continuing in its overall direction. Price movement consists of three main sub-movements: impulse, corrective, and continuation. For example, here, if we consider this corrective move as a valid pullback, we have a confirmed break of structure. Additionally, we can identify an order block situated at the bottom, attributed to the BOS. In this scenario, we await the price to reach our identified order block and reverse its direction to the upside. To align with this expectation, we may position our buy limit order at the highest point of the order block. However, let's imagine a scenario where our identified pullback proves to be invalid, mistakenly considered as a valid pullback due to its impulsive nature. In such a case, our identified order block loses its validity, and there is a high probability of the price triggering our stop loss. Now let's explore how to identify a valid pullback and the criteria and rules we need to consider. Please make sure that you watch the video attentively until the end, because in the second section of the video, we will explore various pullback types, price actions, and discuss trading strategies associated with pullbacks that you might encounter in the market. Before delving into the candlestick examples of valid pullbacks, let's have a quick breakdown of candlestick uptrends and downtrends. A candlestick-based uptrend is characterized by a pattern in which the price action produces consecutive bullish candles, with each candle exceeding the highest point of the previous one, signifying strong upward momentum. For a single bullish impulsive movement, it is essential that the lowest point of each candle remains equal to or higher than the lowest point of the previous candles. This condition indicates that the bearish momentum in the market is restricted, and the overall trend remains predominantly bullish. The same concepts apply to the bearish scenario. A candlestick-based downtrend is characterized by a pattern in which the price action produces consecutive bearish candles, with each candle exceeding the lowest point of the previous one, signifying strong downward momentum. In a single bearish impulsive movement, it is crucial that the highest point of each candle remains equal to or lower than the highest point of the previous candles. Now let's see how we can identify valid pullback in the market. In the bullish scenario, a valid pullback occurs when a candle breaks below the lowest point of the previous candle or effectively sweeps its liquidity. For example, in the given illustration, the last red candle has broken below the lowest point of the third green candle, indicating a valid pullback. It's crucial to note that if the price fails to break below the lowest point of the last green candle, the pullback cannot be considered valid. It's important to emphasize that the color of the candle does not play a role in identifying pullbacks. Similarly, in a bearish scenario, a valid pullback occurs when a candle breaks above the highest point of the previous candles, sweeping liquidity in the process. To solidify our understanding of pullbacks, let's examine more examples. Consider a series of bullish candles as illustrated. After forming 3 consecutive bullish candles, the price forms a temporary pause, marked by the emergence of 3 bearish candles, before resuming an upward push. As previously mentioned in the context of a bullish scenario, for a valid pullback, the price must break below the lowest point of the last bullish candle formed just before the temporary bearish pause. However, it does not qualify as a valid pullback, because none of the bearish candles has broken the lowest point of the preceding bullish candle or swept its liquidity. Consequently, we consider this candle sequence as a bullish single impulse move. In a parallel scenario occurring in the second candle series, we can see that after the formation of successive bullish candles, a temporary pause occurs with the emergence of a single bearish candle, since the price has not broken the low of any previous candle in this sequence. So we cannot consider it a valid pullback either. On the contrary, If the bearish candle forms an equal high with the previous bullish candle, and the subsequent candle breaks and sweeps below the low of the bearish candle, it qualifies as a valid pullback. So here we have a bullish impulsive wave, followed by a correction, and then another bullish continuation wave. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various time frames and any price action-based chart.